Okay. So okay, let's try to move fast because so much is to be covered. Now, when you think of starting a company, definitely accounting should be at the back of your mind. But before that, you want to know how much money I need to start the business. Where all money will be necessary, and how do I come up with a ballpark? You understand? Ballpark means lump sum figure, approximate figure as to how much money will be necessary for me to kick start the business. Once I set the ball rolling, then I'll need more money. But before the ball is set rolling, uh, before you set the ball rolling, how much money will be necessary? Let us see that. Now, to see that, I'll give a very
Sir,
simple example. Yes,
is the slide being shared or not, sir? I couldn't see.
share is being shared. Okay, let me share it again. Let me pull it down and then share it again. I don't know why, but it shows that I'm sharing, and I'm actually sharing. Can you see? Can you see the
Yes, sir.
slides?
Yes, sir. Now
Yes,
it is
sir.
visible, sir.
Okay, because of toggling between here and there, it went outside for whatever reason. So you want to know how much money to be is required to be invested, so that you understand which business to start. If some business require 100 crore rupees and you are thinking to start and you have no idea how to gather 100 crore, then there's no point. So let us start a very simple business. You all have lived in hostels, different hostels. Now you know that in hostels there are business opportunities. Like if you want to buy some pen, you have to go to tech market, or maybe there is a shop at the ground floor, or in some hostel there may not be. Suppose there is no shop in the hostel, and you are thinking that you want to help the students to by providing whatever they need, maintaining that in your room. So you want to start a business in your room, precisely. Stationery shop in your room. Now, this may be too simplistic, but you will know what all you need to really run a big business as well, meaning that may be more complex, but have some idea about it. Now, to start a stationery shop in your room, at the very minimum, you need a rack where you will be putting all the pens, khatas, and all that, whatever you buy, so that students can come at the door and they can have a look inside and pick and choose that, okay, give me that pen or give me that pencil. Then you need a counter. You don't really want to allow everybody, and then uh, on your study table you cannot do the estimate. So there will be a counter where you will keep the things and people will put the money. You will take the money, give the change, return the change, etc., etc. So you need a counter. Counter is nothing but a table, so that may cost you 500 rupees. Rack may cost you something like 600. You need a chair to sit. You don't want to sit on the study chair. You want to have a separate chair, maybe 400. So subtotal is 1500. If you have this 1500 rupees, you are good to go. You don't have any pain. You have not yet bought any khatas or any stationary items. You are ready with infrastructure. These are part of infrastructure. You have a counter, you have a rack, you have a chair. Now, you need stock to sell. Otherwise, unless there are pens, what are you going to sell? So you want to purchase material. These are normally referred to as raw material. Materials that you sell is normally referred to as raw material, because in the context of industry, they remain in the raw form. Then you process that or finish that into a finished product. So that is why raw material and finished goods. On one end of the factory remains raw material. On the other end, the raw material gets converted and comes out to the other end as finished goods. The raw material and finished goods. And in between, it remains within the factory. We call it goods in process, or semi-finished goods, or in process goods, something like that. There are multiple names. Don't bother about that. Now, everything together, from raw material, goods in process, and finished goods, all these items together is called inventory. Remember, I will be referring inventory many a times. This is the meaning. Inventory means it consists of raw material, goods in process, and finished goods. Now, suppose during the course of business, you need some money in your pocket or in the drawer, where if somebody comes with a 500 rupee note, you should be able to give the change. So you need some cash. Normally for every business, people call it petty cash, meaning some loose cash you want to keep there for maybe in a big company. Petty cash is kept for somebody who is going to face something. So you give him some rickshaw fare, or you buy some refreshments, etc., etc. So we don't care, means this is small money, but then every penny is to be accounted for. Every paisa needs to be accounted. So that is why you maintain some 500 rupee cash. That becomes part of your working capital. Whatever goods, whatever inventory you maintain, whatever other assets are there in connection with the operation of the business, not the chair, not the table, not the counter, but things that you're going to sell, these are part of your working capital. These are referred to as current asset, working capital or current asset. So your total current asset is, first of all, 500 rupees, 600 rupees, 400, that makes 1500. Plus you need 5000 rupees, 5,000 rupees your working capital, 5,500. Whereas 1500 rupees is the fixed cost, or cost towards fixed assets, cost towards fixed assets. So this is fixed assets and this is current asset. Total subtotal is 5,500, that is for current asset. Total 5,500 plus 1,500 is 7,000. So this is the money you need to start the business. So if anybody is talking to you and asking as to how much money I will be requiring to start this business, so you need to understand what is the total investment in creating the infrastructure. Suppose you are thinking of starting, yesterday I mentioned about a plastic pen business. That may not be possible in a hostel room. You need a separate building. So suppose you construct a building or take something on rent. Suppose you fabricate the building. So maybe you need something like 1 lakh rupees for a shed. 1 lakh rupees is the minimum investment for the shed. Then you need pressure molding machine. That costs something like 25,000, 1,25,000. Then you need some maybe, after pressure molding, you have to remove the extras. So maybe you need some kind of a polishing machine. So polishing machine will cost you something like a couple of thousand, maybe 2,000. So 1,27,000. Then you need plastic granules, that is for working capital. So maybe you want to maintain something like 50,000 rupees worth of raw material. So 2,27,000 rupees. Then miscellaneous other, consumables like tools, like molds, like many other things, maybe another 50,000. So it becomes 77,000 rupees. Okay, so that is the total money you need to start a pen manufacturing machine factory. And for a stationery shop in a hostel, you need 7,000 rupees. This is called a project cost. This is called the project cost for starting a stationery shop, where you will be maintaining 5,000 rupees worth of stock and 500 rupees worth of cash and some infrastructure, for which you need 7,000 rupees. So in a project report, you start with this. First of all, you write the background. What is the background? You write that in the hostel there are 300 plus boarders, and they hardly have any time. They are bogged down with the studies. So if they have to buy something, they have to go to Tech Market or Gol Bazaar. So that is kind of killing their time, and most of the time people hesitate to go. So they have a huge pain. And I'm going to alleviate that pain by making these products available right inside the hostel. So I'm going to start a stationery shop. So background is made, meaning there is a compelling reason. There is a compelling reason for you to think that a stationery shop is necessary within the hostel, and you are going to do that. And people have a pain. You are going to alleviate that pain. Done. Second is how much money you need to start the business. So you prepare a project cost estimate. This is too simplistic. As I said, for plastic pen manufacturing, or slightly more complex, and for real business, it will be much more complex. For a software company, your infrastructure will be, suppose you don't want to build a building for software company. Normally you get it on rent. So there may be monthly rent of say 10,000 rupees, but the 10,000 rupees is an expense. It does not come in the infrastructure cost. Okay, that is part of expense. Now, what you need infrastructure wise, you need some computers, So maybe suppose you foresee that there will be something like 15 tech guys working for you, but then you cannot buy only 15 machines. Some machines should be at the standby, on the standby, so that if any machine giving trouble or somebody needs some a very specialized app to be maybe some ANSYS software somewhere, so you need some kind of a workstation at a dedicated workstation or something, and maybe a email server or something, whatever. So you need say 20 computers of different capabilities. 20 computers, one centralized printer, maybe a separate scanner, or maybe a telephone, or maybe EPBX, where from you can redirect the calls to individuals. Then you need some kind of a refreshment, so you need a water filter, you need maybe a microwave for tiffin and all that. You need tables where people will be sitting, where computers will be there with drawers, blah 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 blah. So all of that, make aggregate of that or sum total of that is the infrastructural cost. What is the recurring cost? You need papers, you need CDs, you need softwares. Software is infrastructure. At the beginning, you need maybe MS Office, maybe Unix, maybe Linux, maybe some databases, maybe say Oracle or something, I don't know, and whatnot. All these softwares and hardware together will constitute the cost of infrastructure. Then maybe a Xerox machine, maybe or may not be. Telephones on every table, and then some almirah, because you want to keep the precious thing, pricey things protected. Then likewise. Okay, so that is the infrastructure cost. Recurring cost will be, as I said, papers, pens, then CDs, then maybe some tiffin for the employees, maybe what else? Cartridges, etc. These are recurring. Yeah.
Internet connectivity.
Right, very right, very right, very good that you have that thought. Internet connectivity, so data cost will be one of them. Then your website maintenance, there will be some domain name registration fees, then hosting charge, then whatnot. Likewise. So all those are expenses. Telephone expenses is one of the major expenses, recurring expenses. Telephone charge, electricity charge, then water charge in centralized place, water charge. Then there will be a security guard, so you have to pay him. And more importantly, most importantly, not more, most importantly, one of the most important recurring expense is the salary to the tech guys. You have so many guys working for you. Every month you have to pay salary, maybe 50,000, maybe 1 lakh. So total, maybe for 15 guys, you may end up paying something like 12 lakh rupees a month. So that is the major recurring expenses. And that is called operating expenses. We'll define operating expenses moving forward. So all those expenses to be estimated to understand how much money you are going to make in a month or in a year. Suppose your revenue or your sales is suppose 20 lakh and your salary expenses is say 12 lakhs. So 8 lakh rupees is the operating profit. But then out of operating profit, you have to meet your electricity expenses, internet expenses, then hosting charge, then database or server charge, cloud server charge, and things like that. All other rent is a major, like 10,000. I said monthly rent is 10,000. So all of that will be added together. These are operating expenses. You are going to deduct these operating expenses from the 8 lakh rupees that remains. So whatever remains, that will be operating. That will be profit before tax. We'll come to that gradually. Okay, so this is how it looks like. Long-term fixed asset and short-term, that is current asset. We have already discussed this. I don't want to waste more time. Fixed assets are assets which remains with the company for more than 1 year. More precisely, fixed assets are those assets that facilitate your business, but you don't sell them as your main activity of the business. Suppose you have a Xerox machine. You don't sell Xerox machine, but then the Xerox machine may be facilitating your business. So that is a fixed asset. But things that you sell are your current asset. Like say, if you are a stationery shop owner, obviously you don't sell the chair, the counter, the table, but you sell pens, you sell khatas and other things. These are your current assets. They are normally expected to be with the company for less than a year. If anything is remaining more than a year, then normally they are classified as fixed asset or long-term asset. Now you need 7,000 rupees, but you look into your bank account and all other sources, you find that you can arrange barely 3,000 rupees and not beyond that. You don't have any source to get more money. Now you need 7,000 rupees. Without that, you cannot start. So what to do? You approach to many friends. One friend, maybe say some Rohit, he tells you that, okay, I'll give you 4,000 rupees. Don't worry. But you start because you are going to do a nice social job, because we don't have to really travel up to tech market to buy something during rainy season, during winter season, during hot summer. So you are giving a service, wonderful service. So I'm going to give you a loan of rupees 4,000. You have to pay me with interest, maybe 10%. You pay 10% interest, whatever profit you make, I don't care, but pay me 400 rupees interest at the end of the year. I'll be glad. And you should repay this loan every year, some money. Whenever you make profit, you gradually, means slowly, you repay. You don't have to repay once. That is called bullet payment in one shot. You don't have to pay, but you can pay in installment, maybe 2,000 rupees every year in 2 years. Okay, that is the arrangement. So that is called financial closure of the business. You have some business in mind, some whatever stationery shop or plastic pen or maybe software company. Now you estimated that this is the total requirement of fund. Then you assess as to how much money you can bring from your own source. Then you see that, okay, I can bring this, but I have a shortfall of this amount of money. When you see that there is a shortfall, then you approach to different parties, maybe bank, maybe friends, maybe investors. When all the money is arranged, suppose you need 1 crore rupees and you have already tied up, meaning you have approached to different parties and they agreed, and you see that all 1 crore rupees has been arranged or somebody committed. That is called financial closure of a project or a business, meaning you have achieved or reached financial closure of the business. Now let us prepare the balance sheet. Once you have the financial closure, now you can prepare the balance sheet. If you remember from yesterday, I said assets are those where you have applied all the money into, whereas liabilities are the sources of money that you have used to create the asset. So let us talk about liability first at the bottom. Though in traditional balance sheet, you will find they start with assets, sometimes from liability, nothing sacrosanct, but there is always a tradition. So liability comes at the bottom, and at the top of liability is actually owner's capital. I have written that at the bottom. So that is also a kind of a tradition or say standard. So most of the people start with owner's equity. Owner's equity means how much money the owner has brought in plus what is the accumulated profit over the years. Because this is a new business, there is no accumulation of profit. So this is just starting. Let us see where do we stand. That is what is a balance sheet. What is a balance sheet called? A balance sheet is known as a snapshot of assets and liability at a particular point of time. So you are starting a business. Today it is what? 21st of January. You are starting the business. So today you have you talked to Rohit, and Rohit said, yes, I'll give you 4,000. So you are elated that I am going to eventually start the business. Let me see my asset liability status as of today. So it need not be as on 31/3/2020. It can be as on 21st January 2021. Okay. So you see the liability, meaning what is my sources of money? Long-term loan from, so okay, let us start from beginning. Accounts payable, actually business is yet to start. That is why there is no account payable. Short-term bank loan nil. Long-term bank liabilities is not there. So only thing is there is the other loan from Rohit. That is 4,000 rupees. And owner's equity, because you are bringing in 3,000 rupees. That is why owner's equity is 3,000. Total is 7,000. Where you have applied those money. Number one, you are maintaining a cash of 500 rupees. You look into the balance, into your cash box, count the cash. You find that there are 500 rupees there. Account receivable is yet to come because business has not yet started. Inventory, you have already bought pens, papers, etc., worth 5,000 rupees. Furniture fixture, you have already bought the chair, already bought the counter, already bought the table. So rack. So total is 7,000. So you have 7,000 rupees money and you have already invested that 7,000 rupees in the form of infrastructure and current asset, including cash. Okay. So it is called tied up of the balance sheet. Balance sheet always is tied up, meaning whatever is the total asset, that should be the total liabilities. There cannot be any gap. Why? Because if there is any asset, it must have been procured with some source. So sources and application must apply. They are just the counterpoint. They're not different. This is the total source of money, and this is where the money actually have been invested. Monies have been invested or kept. So together it is there. Right. You have now started the business on 1st of April 2020. Not 2020, today. Whatever, let it be 2020. Otherwise, every time I'll make unnecessary references. This is based on previous semester's data. I did not change because still a financial year is not over. This financial year will be over on 31st of March 2021. So that data remains valid. Okay. Now you started the business and business is doing kind of brisk business. People are coming, people are buying, everybody is happy. So you are also happy, you are attending class and selling goods. But then most of the people are complaining that, I had an off period. Then I came to your shop. I didn't find anybody. So I couldn't buy. And I had to run to the class. I could not buy the khata. I had to go to class without a new khata. So I have no other option but to go to Tech Market. So what is the point you opening this shop? When I need the goods, I don't get. And at the last moment, if I see that your shop is closed, then I don't have the time to go to Tech Market. So I'll never depend on your shop. Then you see that there is a reason. So I have to have the shop open 24/7, literally. So you hire a guy so that he remains during the period when you are in the class. So you pay him 5,000 rupees. So when you recruit a guy, you cannot depend on him with cash, with everything. So you want to buy a billing machine so that whenever he does a transaction, this is entered into billing machine. At the end of the day, you can, match the stock, take inventory, meaning whatever inventory is there and how much is less. So you match that with cash and you see that whatever is less that have been sold and the money is there in the cash box. So for that, you need a cash machine as well, meaning billing machine as well. So you buy a billing machine for maybe, what is there? No, it is not there. It is yet to come. Okay, let us suppose this is the data for one particular year. You already bought the machine. So this is your sales is 5 lakh rupees in a year and you bought material worth of 2,50,000. Get this? Your sales is 5 lakh rupees and you made total purchase of 2,50,000. If some of you think that my profit is the remaining amount, then you will be surprised that it is not the case. 5 lakh rupees minus 2,50,000 is 2,50,000. That is not the profit because you paid salary to this guy who is running the business in your absence. That is equal to 60,000 rupees. You are paying rent to IIT 1,000 rupees a month. So total is 12,000 rupees. Now you have a closing stock at the end of the year. Suppose year ends on 31st March 2021. Suppose. So means suppose we are on 2021 31st March, you are looking back and you saw that your closing stock as on 31st March 2021 is 10,000 rupees. That means this is the stock that you bought but you could not sell during the year. This remains unsold. Obviously you go to Tech Market any day on 31st March or any day, you will find that a lot of stock always remains. They never empty the shop. No, on no date they will be emptying the shop. Okay, so this is the salary, then rent, then closing stock, transportation cost, like when you go to Gol Bazaar to buy something or you tell your staff to go to Gol Bazaar, bring some goods, he will go buy maybe auto rickshaw or rickshaw or taxi or something. Then you have paid 5,000 rupees towards that. For telephone bill you paid 3,000, electricity bill 6,000, trade license renewal 5,000. Without a trade license you cannot do any business. Remember that. Now all these infrastructure that you have created, like the shelf, like the rack, like the table, chair, the investment that you made, this is also part of the business. Now you have invested money on that, and these assets at some point of time will through wear and tear, this will become damaged. So whatever money you have invested in them, you need to recover them over a period of time, because this asset will be used for maybe 5 years or so. So you would like to distribute that cost equally in this 5 years. Then whatever is the cost of every year, that becomes a current cost. So that amount will be added as depreciation. Every year there will be a small component of expense that represents the wear and tear of the fixed assets, and that you use as expense in your profit loss account. You show this as depreciation. Now, how depreciation is calculated should be another lecture, but I'll just introduce what is depreciation. I'll explain that moving forward, and then for depreciation we'll have a separate lecture, maybe tomorrow, maybe some other day. Then there is some more items like accounts payable, meaning you are bringing raw material or material for selling from Gold Bazaar. It's not necessary that always you make payment. You send this guy, go bring so and so items for worth 25,000 rupees. Now in your cash box you see that there are only say 13,000 rupees. So you tell this guy that you bring goods worth of 25,000, so you pay him maybe 12,000 rupees later. You tell him that means you keep it on credit. So whatever remains on credit means whatever payment is due, you have to make payment. These are called accounts payable, meaning you have to pay. That is why the word payable. So accounts payable is 12,000 rupees as on 30/3/2021. Now you are selling to students. Many of the students will say, we'll pay later. Don't worry. We are there in the hostel. I'm not running away anywhere. I don't have cash on me, and you don't have that, you pay system or anything. So many guys will tell you, I'll pay later. So at any point of time, say on 31/3/2021, you see that total amount that people are yet to pay you add up to 15,000 rupees. So this is the amount that you are supposed to receive. That is why it's called accounts receivable. Why accounts? Meaning it is on many people, on the head of many people. That is why accounts receivable, accounts payable. Two are very different on the opposite side of balance sheet. Now there are many kinds of profit. Once you have this data, then you embark on preparing the profit loss account. While preparing the profit loss account, you will estimate gross profit. That is sales minus cost of goods sold. Then you estimate operating profit. That is gross profit minus other operating expenses. Then you prepare profit before tax, which is equal to operating profit minus interest. After you get profit before tax, you estimate net profit. That is nothing but profit before tax minus income tax. Now, if you are running the business, you are running the business for your own good. So you want to take some money out of the business. Yesterday I mentioned that business and you are two different entities. Remember this, that business and you are not the same person. In fact, if your business can file a case against you, it can go to that extent. Except giving vote, a business can do literally anything that a human being can do. It can own property, it can sell goods, it can do anything. Literally, it can borrow money, it can lend money, it can do anything that an individual can do. That is why they are separate entity. So when you want money from the business, you have to ask the business, almost like asking to your dad that give me some money. So you're going to ask your business, give me some money. And the business is going to give you money in the form of dividend. The business is going to tell you, okay, guy, you have done a wonderful job. You have made some profit for me. So take this money as dividend. So you don't literally tell them, but you work on behalf of the business and then decide that, okay, let me take a dividend of this amount. Suppose you make a profit of 3 lakh rupees. and you will be comfortable taking a dividend of say 2 lakh rupees. So you take a 2 lakh rupees dividend, rest 1 lakh rupees remains as retained earning, retained profit. It remains as retained profit. In the balance sheet, you show that my retained profit is shown as reserves and surplus. Your reserves and surplus is 1 lakh rupees from this year. Then next year, if reserves and your retained profit is another say 3 lakh rupees, then you add it up, it becomes 4 lakh rupees. Retained profit becomes, or reserves and surplus becomes 4 lakh rupees. That is how normally you estimate.
Sir,
Go ahead.
Sir, can you please explain about the interest expenses?
Okay, interest expenses is, see, your friend gave you some money, 4,000 rupees, and he told you that annually you have to pay me interest because you are using my money. I could very well deposit that money in State Bank of India and earn interest of say 7%. So I am losing that. So when I am giving you money, you have to pay me interest, and you are not as secured as a state bank. You may very well run away with the money. Something can happen to you. Your business may go down. So I will be comfortable if you pay me 10%. So you agreed that, okay, I'll pay you 10% rate of interest on your money. So he gave you 4,000 rupees. 10% of 4,000 is 400. So you will be paying him 400 rupees as interest. That is an expense for the business. Okay. That you are going to pay out of your sales. Whatever you are selling, you have to pay interest out of that. Now, if you borrow that money from bank may charge you 12%, 13%, 15%. Whatever is the percentage, you have to pay interest on that at that rate. Okay.
Okay, sir. Okay, sir.
Okay, let's move forward. We'll see more about that. This is just,
So,
yeah.
so
Go
one
ahead.
doubt I had in the previous slide.
Yeah.
So is the gross profit same as net profit before tax?
Not at all. Whatever profit I showed, they are all different. Gross profit is sales minus cost of goods sold. Suppose you are manufacturing plastic pen. I'm not talking about the stationery shop, that is slightly different. Suppose you are manufacturing plastic pen. Now, what are the elements that go into making a pen? You need plastic granules. So you, whatever for per pen, suppose for one pen, the cost of plastic granules that go into making one pen is suppose 50 paisa. Okay. Then there is a clip for hanging on the pocket. Suppose that is 10 paisa. So 50 paisa plus 10 paisa makes 60 paisa. Suppose there is a separate, what is that called inside? Nib or something, refill. There is a refill. So refill cost suppose is another 50 paisa. So it becomes 1 rupee 10 paisa. So altogether it is 1 rupee 10 paisa. That is the cost of goods sold. Suppose now you sell this pen for 5 rupees. You sell the pen for 5 rupees, for which your cost of goods, meaning material cost only is 1 rupee 10 paisa. So you deduct from sale of 5 rupees, you deduct that 1 rupee 10 paisa. So you have 3 rupees 90 paisa. That is your gross profit. Okay. Now,
So,
yeah.
yes, yes. Yes, so that only like gross profit. So that will be like same like profit before tax, because right now we have not.
I'm coming. Yeah, hold your horse. I'm coming. Just give me some time. Now, what is your gross profit? 3 rupees 90 paisa. Now, it does not contain, it does not account for labor cost. Suppose per pen you have given it for contract to somebody to manufacture. Per pen cost, labor cost is suppose 1 rupee. Hypothetically, it will not be 1 rupee, or say labor cost is say another 30 paisa, not 1 rupee, 30 paisa. Labor cost is 30 paisa. Now, okay, for cost of goods sold, there is other cost also. Packaging cost also should be accounted for. Suppose packaging cost is another say 30 paisa. So it is 1 rupee 10 plus 30 is 1 rupee 40 paisa. And you are selling it for 5 rupees. So you are making a gross profit of 3 rupees 60 paisa. Now, suppose labor cost is 30 paisa. per pen, suppose rent cost is 10 paisa, so 30 plus 10 is 40 paisa. Now, suppose for electricity cost, for transportation cost, for many other costs, suppose it is say another 1 rupee, hypothetically. So 1 rupee 40 paisa is the operating expenses. Okay. So your gross profit was 3 rupees 60 paisa. Now deduct this 1 rupee 40 paisa from 3 rupees 60 paisa, you get 2 rupees 20 paisa, right? 2.2, that becomes your operating profit per pen. Operating profit per pen. Now from operating profit, you have to deduct interest. Now you have borrowed some money. Now suppose every month you are giving some interest. So on a per pen basis, suppose your interest cost is say 20 paisa, suppose hypothetically. So out of this 2 rupees 20 paisa, you are paying interest of 20 paisa. Whatever remains, that is 2 rupees, that is your profit before tax. Get this, profit before tax. Now you have to pay tax. Present tax rate is about 22%. Suppose it is 20%. So out of this 20 rupees, you pay tax to the government of 40 paisa, that is 20% of 2 rupees. So you are left with 1 rupee 60 paisa. That is your net profit, 1 rupee 60 paisa. Out of that, if you draw some money, that goes as dividend, rest remains as retained profit. Normally, we don't estimate profit on a per pen basis. I have just, for the sake of giving an example for easy understanding, I gave this example like this. Now you extrapolate that to a particular year. Suppose in a year you have sold 1 million pens. What is the material cost? Maybe say 1.4 million rupees. Then whatever is the operating expenses, other expenses, then deduct everything. So you will be left up with 2 million rupees before tax. Then you pay a tax of 0.4 million. So you'll be left up with 1.6 million rupees as net profit after tax. That means 16 lakh rupees, right? So that is how all the profits are estimated. Get this. There is another kind of profit that is called EBITDA. Earning is nothing but profit. Earning is an American word. Profit is an Indian word. So normally all financial innovation comes from US. That is why we normally follow American pattern. So that is why we call it EBITDA. It is not actually EBITDA. It should be PBITDA because it is profit before interest, before tax, before depreciation, before amortization. So depreciation and amortization are almost the same thing. I'll explain it there. There is a succinct difference, but for the time being, let us call it depreciation alone. So your profit before allowing interest, before allowing tax, before allowing depreciation, whatever is the profit, that is the EBITDA. So it is almost like operating profit. Operating profit minus depreciation is EBITDA. Okay. And for every profit, you can estimate margin. If you estimated gross profit divided by sales is gross profit margin. Operating profit margin is operating profit divided by sales. Denominator is always sales. Denominator is always sales. Numerator is always the profit. If net profit, if you want to estimate net profit margin, it is net profit divided by sales. Okay. Why different types of profits? It's a huge discussion. I will be discussing that in details later if I remember, but for the time being, suffice it to say that unless you estimate different profits, you won't be able to compare apple and apple, because for every company, capital structure is different. And if capital structure is different, their cost structure is different, their interest structure is different. For some company, interest is very high, some company, interest is very low. So depending on that, the comparison will vary across companies. Like say this is an example to demonstrate that the utility of different kinds of profit. I have compared between Mahindra and Mahindra, Tata Motors, Maruti Suzuki across 2 years, same 2 years. For Mahindra, total sales were 950 crore and then 1047 crore and the like. Then I have estimated the operating profit and operating profit margin. Look at the margin. Mahindra has the best margin, 15.47, 14.30, etc. Whereas Tata Motors has the worst margin in operating level. But then they have positive operating profit. Whereas Maruti has kind of good operating profit percentage. Then estimate interest. See, Mahindra has the highest interest payment. No, sorry. Almost 60, 50, then 72, 57, then 1 crore, 0.0 crore. Maruti has almost no loan, almost no loan. This is the interest on loan. So interest percentage to operating profit, Mahindra has the largest, Tata Motors has low, and Maruti has very low. Now look at the net profit. You will understand the utility of those profits. See, Maruti has almost no debt. That is why even though their operating profit margin is not so great, but their net profit is great. See the net profit. See the net profit for Maruti, net profit margin is 7% and 9%. I think this is percent. I might have made a mistake by showing in fraction. It should be percentage. So it should be 7%, 9%. Whereas Mahindra has almost no profit. Tata has zero profit, negative profit, means they are in the loss. And that is why Maruti's share price is 7,000 rupees. Mahindra share price is only 600 rupees, whereas Tata's share price is only 148. Now, if somebody wanted to decide based on sales, look at the sales data. Tata Motors has the highest sales, 3,019. I think this data is not right. This is a quarterly sales, I believe, because total sales of Tata Motors is in the range of 30,000 crore to 50,000 crore. If you think in terms of consolidated profit, even Maruti also, this is not net sales. This data is wrong. Operating profit, wrong or right, whatever, just go for a comparative study. Don't look at the absolute value of the data. So absolute value, if you look at on a comparative basis, Tata Motors has the best of sales, worst of profit. That is why the share price is worst, even though sales is best. So people don't depend on sales. People don't depend on operating profit alone. They also see profit before tax, they see profit after tax, the net profit margin, they see all of that. Only then they make a decision. We'll discuss, if there is time, we'll discuss about this later. I'm not very sure whether time will be there, but if anybody has specific question, you should ask me later after we finish balance sheet, profit loss account and cash flow statement. So why to estimate different profits? Gross profit reflects efficiency of converting input into sales. If one company's gross profit margin is more than others in the same industry, it is because on or more of the following: more efficiently converted raw materials into finished goods. Look at this. Tata Motors operating profit margin is very low. Why? Because perhaps Tata Motors is a very old company, so their system is inefficient. That is why they consume more raw material than Maruti, than Mahindra. See, their operating profit margin is only 8% or 9%. That means their material cost is very high. That means they cannot manage their vendor well. So look at this data. Analysts will be looking at this data and then they will come up with a lot of insights. That just looking at operating profit margin, they will say that Mahindra has been able to manage their vendors well. That is why they are ending up paying less money to the vendor. So their material cost is less compared to Tata Motors. Same with Maruti Suzuki. Whereas Tata Motors has direct access to Tata Steel to buy majority of the raw material, steel raw material. Whereas even then their material cost is so high. That is why their operating profit margin is so low. So if you see that some companies' operating profit margin is low, you tend to think that this company is good for nothing. We should not buy their shares, something like that. And then if some quarter, if you find that their operating profit margin is improving, that gives a good, indication that perhaps they're now on track. They're managing their material cost, and now they're into profit. So maybe next year it will do much better. So you buy that share and then wait for this company to come up with annual result that is going to be good. So likewise, you look at every data and then decide on their different capabilities. If you see that operating profit margin is good, but profit before tax is not good, that means this company is loaded with debt, meaning they have huge amount of debt on them. Look at Mahindra and Mahindra. Their operating profit margin is as good as Maruti, but their interest cost is very high. That is why their share price is nowhere close to Maruti, and that is why their net profit is so low, because major portion is being consumed in the form of interest. So if you are an analyst, you have to know all of that to make a informed comment, so that to whosoever you are talking, all these make sense, that yes, these are relevant. So I should not invest, I should invest less in Mahindra, even less in Tata Motors, but more in Maruti, because they can manage their raw materials well, cost of raw materials well, and they should be, they have no loan, etc. So they will remain strong. Now, coming to another reality. When I'm planning to buy my next car, this is something very different, but this data will tell you why. I'm going to buy a new car now. And I was talking to my son, and he tells me that you buy a Honda. I have a Maruti now, but I want to buy a Tata car because of many reasons. One of the reasons is that Ratan Tata has so much social contribution during this COVID situation. He donated 15,000 crore rupees or so to government of India towards finding a solution for this. And there are so many things that Tatas do. During the riot, 84 riot, is unthinkable things that they do. Unless you know all this, you will never have idea how much the corporate world actually contributes to the social development. I am spending some time to tell you this story. During this riot, the Sikh riot, the Punjabis, the Indira Gandhi was murdered, and then what is 84 or something? If I'm not very incorrect, it should be that way. So many these Punjabis were running this truck business, and many of the trucks were destroyed. Whosoever is the culprit, forget about that part, but destroyed. And many people were, they had only one truck. That is their lives, that is their bread, butter, jam, jelly, everything. And what Ratan Tata did, you will not believe. He sent truck keys, with their officials, and handed over the keys to these people. Whosoever lost truck, they handed over keys to these guys. And they told them that you have to go and drive your truck from so and so distributor or dealer. Just start over. Your life should start over from here. You don't have to pay anything. Just drive the truck, bring the truck and start driving. That will help our economy. That will help you to maintain your family. That is the approach that Tatas have. I won't say all the Tata companies have that same mindset. I invested in Tata AIG, I suffered a huge loss, but then I'm still enamored with them, and I would like that my next car should be the Tatas. Why? There is another reason. One reason I told. Another reason is that Tata car has the best safety features. And if you look at the raw material cost and gross profit margin, it glaringly tells us that they use more material, more steel in a car than any other company. That is why their raw material cost is high. That is why gross profit is less. Get this? Straight and clear. So Tata has a 5-star safety rating. No other Indian company has 5-star rating. Why? Because on a crash, Tata car will not become a kind of a bundle of junk, because their sheet metal is very strong. Their chassis is with strong metal, and there are more metals than any other car. Okay, well, less diversion. Now there is another concept. I'm going very slow, and there are too much of stories. Can't help. Don't worry. Whatever you learn thoroughly. That should be good enough. Now, there is a distinction between profit loss account and balance sheet. I said balance sheet is a snapshot. It can be referring to any particular date or any particular time. If I say that my balance sheet as at 12 o'clock on 21st of January 2021 is like this, maybe my balance sheet will change after an hour. Suppose I buy something or I sell something. After that, my balance sheet will change. But as of now, the balance sheet is something. So it makes sense to refer the balance sheet with time or with date. Normally, people refer it with date. Whereas profit loss account is for a period of time. period of time, not time, for a period of time. So what is a period of time? Starting from a date, ending from on a date. So normally it starts from beginning of the financial year. What is a financial year? Years may be different. One is calendar year. So look at the calendar. It starts from January, ends on 31st December. That is called calendar year. Financial year may be different than calendar year. It may be the same. In many countries, it is the same. Calendar year and financial year are the same. But in India, mostly financial year starts on 1st of April this year. It ends in the 31st of March in the next year. That is financial year. Mostly. Even for income tax return, we follow that financial year. That is why balance sheet normally refers to 31st March of particular year, whereas profit loss account refers to the year together, like starting from 1st of April till 31st of March. That is the period for which we prepare profit loss account. This is for annual profit loss account. It can be a half yearly profit loss account. It may be a quarterly profit loss account. Like at present, companies are publishing December quarter results that began on 1st of October and ended on 31st of December. So this is a quarterly operating statement or profit loss account. Sometimes it is called operating statement. Forget about that part, whatever. Okay, so this is how year changes. So your closing stock of inventory, meaning if you are running this stationery shop, so whatever you see when you go to bed, whatever you see in your room as stock or lying there unsold, this is referred to as closing stock. Every day there will be a closing stock. But on the end of the year, on 31st of March 2020 or 21 or any other year, whenever you go to bed, look at your racks and tables and everything, and whatever you see, everything together represents your inventory, closing inventory, closing stock of raw material, closing stock of finished goods, etc. Next day when you wake up, whatever you see, that represents your opening stock, opening inventory, etc., etc. So this is very important. When we'll be preparing your balance sheet and profit loss account, this signifies a lot of things, and this is very important. Guys, today time is almost up. Just I'll take one more minute. Let me see if I can finish something more. Now, I talked about gross profit. I'll just explain what gross profit is so that you have a fair idea. You already have a fair idea. So gross profit is sales minus cost of goods sold. Now, suppose you are running a stationery shop in your hostel. What are the cost of material? It is just the goods that you sell. Suppose in a year you sold 100 pens. So the cost of those 100 pens means the money that you paid to the supplier for those 100 pens is the cost of goods sold. But then you don't buy 100 pens to sell 100 pens. You actually buy many pens. Then over the years, you keep on selling. At the end of the year, you see how many pens you bought, how many pens are remaining unsold. You deduct that to find how many pens you sold. Then you estimate the cost of that. You deduct that from total sales to get gross profit. So if you have started the business maybe some years back, not this year. Yes.
So then isn't the closing stock counted twice?
Yeah, I'm coming to that. Suppose you have started the business in the previous year, some previous year, we do not know. When this year started, when the year starts, 1st of April. Suppose 1st of April 2020, a new financial year began. Then when the year began, you woke up on 1st of April 2020 and you took stock of the situation. You took the inventory. You estimated how much pen are there, how much khatas are there. Means that is the stock that that year began with that. So that is called opening stock. So this stock came from the previous year. Now during the year, you made some purchases that is worth 2,50,000 rupees. And at the end, suppose on 31st of March 2021, you take stock again before going to bed, you found that there is still a stock of 10,000 rupees. So this was not sold. How much you sold? That is the question. So you started the business with 5,000 rupees during the year. You bought 2,50,000. So total available stock was 2,50,000 plus 5, 2,55,000 rupees. But some pens, some khatas remain unsold, that is worth 10,000. So you deduct that. You have not sold them. You sold a stock whose cost is only 2,45,000. So if you can estimate this, then suppose your sales is 5 lakh rupees. Then your total cost of goods sold is 2,45,000. You deduct that from sales. So your gross profit is nothing but 5 lakh minus 2,45,000 is equal to 2,55,000 rupees. This is the gross profit. We are yet to deduct labor cost or salary or depreciation or transportation, traveling and other cost that comes with operating expenses. I'll not go ahead with that, but gross profit is estimated this way. So we'll start from here tomorrow. Okay. Now the time actually is up. If anybody has question and if you can stay here, I can clarify. Other people may leave if they have a class.
Sir, can you go to the first balance sheet?
Sure. Yeah, this is the one.
No, sir, which had 5 lakh rupees and the different profit.
Oh, that is not balance sheet. Just a second. I'm not very sure which one you are referring to. We started from here today.
Sir, probably the
5
depreciation one.
Okay. Yeah, this is on.
Sir, so here is the purchase of materials including that closing stock.
No. Purchase means you are bringing new. The opening stock that came from the previous year, that was already there in your shop. So that is not purchase. Purchase is new stock arrived in your shop from outside.
Okay, sir.
Okay. Plus with this you add whatever was there already in the shop. That was worth 5,000 rupees. That is the closing stock of previous year. Right. Get this. Okay, actually there is something hidden. Yeah, it is at the bottom. Opening inventory was 5,000 rupees. So this 2,50,000 plus this opening inventory makes 2,55,000. So you had 2,55,000 worth of stock available during the year. From there, you deduct this closing stock because this stock that you could not sell during the year that remained unsold. So you deduct that. So total you sold 2,45,000 worth of stationaries for 5 lakh rupees. This is the cost. And you got 5 lakh rupees out of that. So sales is different than raw material cost. Right. Done.
Yes, sir. Thank you.
Okay. Any other question? Okay. Actually, you have far exceeded the time, but anybody should be able to leave. Okay. Thank you so much. I'll call it quit here.
Thank you, sir.
Welcome. Thank you. So I'll have to stop recording first.